In February 2026, the global financial system is entering a phase best described not as fragile, but deceptively calm. Markets appear orderly on the surface, growth forecasts remain positive, and volatility indicators sit far below crisis levels. Yet beneath this apparent stability, structural stresses are accumulating across sovereign debt markets, private credit, artificial intelligence investment, and geopolitical capital flows. What makes this moment uniquely dangerous is not a single excess, but the synchronization of multiple fragile systems, each capable of amplifying shocks in the others. Global growth for 2026 is projected at roughly 3%. At first glance, this suggests resilience, but aggregate numbers obscure divergence. The United States continues to grow above trend, while much of the G7 struggles with sub-1% expansion. China is slowing structurally. Europe is constrained by fiscal rules and energy insecurity. This unevenness matters because it creates asymmetric policy constraints. Some economies still fight inflation, others flirt with stagnation, and none have the political room to absorb another major shock easily. The United States sits at the center of this tension. Growth remains solid, but it is financed by unprecedented fiscal deficits. Federal debt has climbed to roughly 128% of GDP, and refinancing needs are expanding rapidly in a higher rate environment. For over a decade, markets assumed that U.S. debt sustainability was guaranteed by low interest rates and global demand for treasuries. That assumption no longer holds automatically. When real interest rates rise above real growth, debt dynamics turn hostile. The math becomes unforgiving even for reserve currency issuers. Despite this, financial markets remain unusually complacent. Equity valuations are elevated, credit spreads are tight, and risk assets price in continued technological productivity gains. Particularly from artificial intelligence, the VX Volatility Index oscillates around the low 20s, signaling mild unease rather than fear. This is a classic late-cycle signal. Investors acknowledge risk intellectually but refuse to reprice it materially. One of the most underestimated vulnerabilities in 2026 is the expectation embedded in AI-driven growth narratives. Markets have capitalized future productivity gains aggressively, treating AI as a near-term profit engine rather than a long-term infrastructure bet. When expectations become consensus, disappointment becomes systemic. If productivity gains materialize slower than projected, asset prices tied to these assumptions do not simply adjust gradually. They reprice abruptly because leverage magnifies belief. The danger is not confined to technology stocks. Household wealth effects link equity valuations to consumption, credit quality, and political stability. A sharp AI-led market correction would weaken household balance sheets, reduce risk appetite, and strain credit markets already vulnerable from years of yield chasing. This is how narrative bubbles evolve into macro shocks. Another critical layer is inflation. Headline global inflation is trending lower toward the high 3% range, but remains above pre-pandemic norms. Structural forces are keeping prices sticky. Defense spending, energy transition costs, supply chain fragmentation, and demographic pressures. This creates a stagflationary bias. Central banks cannot easily cut rates without reigniting inflation, yet keeping rates high intensifies debt stress across governments, corporations, and households. The result is a narrowing of policy space. In 2008, governments could socialize private losses through stimulus and monetary easing. In 2026, public balance sheets themselves are a core vulnerability. This inversion is historically rare and profoundly destabilizing. When the state becomes the weak link, crisis management becomes reactive rather than preventive. Layered onto this macro backdrop is the migration of risk away from regulated banks toward less transparent financial actors. While traditional banks appear well capitalized, This strength masks a transfer of leverage into shadow banking institutions and private credit vehicles. These entities are lightly regulated, reliant on wholesale funding, and deeply interconnected with the formal banking system through credit lines and derivatives. Stability in the core increasingly depends on fragility at the edges. Markets often underestimate such systems because they perform smoothly until they do not. Liquidity appears abundant until confidence breaks. Then, funding evaporates faster than models predict. This dynamic is not hypothetical. It is structurally embedded in modern finance, and 2026 presents all the necessary ingredients for its reactivation. What ties these threads together is incentive alignment. Governments are incentivized to borrow, investors to reach for yield, corporations to financialize growth narratives, and institutions to shift risk off balance sheets. Individually rational decisions accumulate into collectively irrational outcomes. Systemic risk is not born from malice or ignorance, but from incentives interacting under constraint. The financial system in early 2026 is therefore not standing at the edge of a single cliff. It is navigating a narrowing corridor where small shocks can ricochet unpredictably across interconnected structures. The most dangerous periods in financial history are not those of panic, but those of misplaced confidence. This is one of them. To understand where the next fracture may originate, we need to look beyond headline indicators and into the plumbing of modern finance. The most consequential shift of the past decade has been the explosive growth of non-bank financial institutions, often referred to as shadow banking. In 2026, these entities are no longer peripheral. They are central to credit creation, maturity transformation, and risk transmission. Yet they operate outside the regulatory perimeter designed after 2008. Private credit funds now originate more than half of new corporate loans in the United States. Pension funds, insurance companies, and sovereign wealth funds have poured capital into them, attracted by yields that appear stable and insulated from public market volatility. The problem is that this stability is largely an illusion created by infrequent pricing, flexible accounting, and contractual structures that postpone loss recognition. Risk is not eliminated, it is delayed. As interest rates remain elevated, many private credit borrowers are no longer generating sufficient cash flow to service debt conventionally. To avoid defaults, lenders increasingly rely on payment-in-kind mechanisms, allowing interest to be capitalized rather than paid in cash. This keeps loans technically current while leverage quietly compounds. From a system perspective, this is dangerous. It transforms liquidity stress into solvency risk and compresses future recovery values. The first full credit cycle for this market is now unfolding. Unlike 2008, where subprime mortgages were widely distributed but relatively standardized, private credit exposures are bespoke, opaque, and difficult to unwind. When stress emerges, there is no deep secondary market to absorb forced sales. Prices gap lower, not gradually but discontinuously. That is how liquidity crises metastasize. Critically, the traditional banking system is not insulated from this process. Large banks provide credit facilities, derivatives hedges, and warehousing services to private funds. In a downturn, these funds are incentivized to draw down committed credit lines precisely when banks are under pressure. This effectively converts contingent exposures into realized ones, pulling stress back onto bank balance sheets and, ultimately, towards central bank backstops. International stress tests already hint at this vulnerability. In scenarios where non-bank institutions amplify shocks, a meaningful share of U.S. and European banks experience sharp capital erosion. This does not imply imminent collapse, but it does imply policy dilemmas. Regulators can tighten oversight, but doing so risks freezing credit. They can provide liquidity, but that entrenches moral hazard and political backlash. Parallel to private credit, fragility sits another underappreciated pressure point: pension systems. Many defined benefit pension funds appear well-funded after years of asset appreciation and higher discount rates. Yet their stability depends on complex leverage strategies, particularly liability-driven investment frameworks that use derivatives and repo financing to hedge interest rate risk. These strategies work until volatility spikes. In a stressed environment, margin calls force pension funds to liquidate their most liquid assets, typically government bonds. This selling pushes yields higher, triggering more margin calls in a sell-free, enforcing loop. The United Kingdom experienced a version of this in 2022. By 2026, the scale is larger, liquidity thinner, and central bank balance sheets are no longer expanding automatically. The risk is not insolvency, but market seizure. Geopolitics adds another layer of instability. Capital flows that were once treated as apolitical are increasingly weaponized or reassessed through strategic lenses. European pension funds and sovereign investors have begun reducing exposure to U.S. Treasuries, citing fiscal sustainability, political polarization, and strategic autonomy. Individually, these reallocations are manageable. Collectively, they matter. Foreign investors hold trillions in U.S. government debt. Even a modest diversification away from treasuries raises borrowing costs for the U.S. government at a time of record issuance. Higher yields feed directly into mortgage rates, corporate borrowing costs, and fiscal interest expenses. This creates a feedback loop between geopolitics and domestic financial conditions that did not exist at this scale a generation ago. Debt sustainability is ultimately a function of arithmetic, not sentiment. When interest rates exceed growth rates and primary deficits persist, debt ratios rise mechanically. Governments can respond through fiscal consolidation, financial repression, inflation, or restructuring. Each path carries social and political costs. In 2026, few democracies appear capable of sustained austerity, making inflation or subtle repression more likely. This is where the role of U.S. Treasuries as global monetary infrastructure becomes crucial. They are not just assets, they are collateral underpinning derivatives, repo markets, stablecoins, and payment systems. Disruptions in Treasury market liquidity would ripple instantly across traditional and decentralized finance. Stablecoin issuers alone hold vast quantities of short-term government debt. A treasury shock becomes a digital payments shock by default. Artificial intelligence adds acceleration to all these dynamics. Trading algorithms respond faster than human judgment, amplifying price moves when technical thresholds break. The sharp collapse in precious metals prices in early 2026 illustrated this vulnerability. Assets traditionally viewed as safe havens became sources of liquidity extraction. Investors sold what they could, not what they wanted to. This behavior is rational under stress. Liquidity dominates valuation. When leverage unwinds, correlations converge toward one. Diversification fails precisely when it is most needed. AI-driven execution does not create this logic, but it compresses the time frame dramatically, reducing the window for policy intervention. Finally, technological risks themselves must be acknowledged as systemic amplifiers. Concentration in cloud infrastructure, data providers, and AI platforms creates single points of failure. A major cyber incident or infrastructure outage would not remain a technical issue. It would interrupt settlement, payments, and confidence simultaneously. Financial systems are only as resilient as their weakest operational dependencies. All of this points to a sobering conclusion. The defining risk of 2026 is not any single collapse scenario, but the interaction of many fragile equilibria. Debt, leverage, technology, and geopolitics are no longer separable domains. They are tightly coupled systems. In such environments, black swan events are rarely exogenous surprises. They emerge from internal dynamics that were visible but discounted until the moment they converged. One sector where these interacting risks converge most clearly is artificial intelligence infrastructure. By 2026, AI is no longer just a software story. It is a capital-intensive industrial build-out involving data centers, specialized chips, power generation, cooling systems, and network capacity. The scale is enormous. Over $100 billion in spending has been shifted off corporate balance sheets into special purpose vehicles funded by private equity, credit funds, and structured products designed on Wall Street. This financial engineering changes the risk profile fundamentally. Instead of technology companies bearing the full downside of long-dated investments, risk is distributed to investors who often lack transparency into cash flow durability. These projects assume sustained demand growth, stable financing conditions, and rapid productivity monetization. If any of those assumptions fail, losses do not remain contained within a single sector. They propagate through credit markets, structured finance, and institutional portfolios. The fragility lies in timing. AI infrastructure projects have long payback periods. Debt service begins long before revenue stabilizes. When interest rates were near zero, this mismatch was tolerable. In 2026, it is not. Refinancing risk is acute. If capital markets hesitate, even briefly, projects stall, covenants trip, and asset values reset downward. The narrative shifts from growth to survivability almost overnight. This is why comparisons to 2008 are misleading if taken too literally. The global financial crisis was rooted in household leverage and housing collateral. The state could step in because public balance sheets were comparatively strong. In 2026, the risk is embedded in sovereign debt, strategic technology investment, and pension promises. The buffers that absorbed shocks before are thinner now, and the political tolerance for bailouts is lower. Another crucial difference is inflation. The 2008 crisis was deflationary. Asset prices collapsed, demand evaporated, and central banks could cut rates aggressively without fear of price instability. A future crisis in 2026 would likely be inflationary or stagflationary. Supply constraints, defense spending, and energy transitions do not disappear during downturns. This traps central banks between financial stability and price stability, forcing trade-offs that markets are not accustomed to pricing. Recent market behavior offers a preview. The sharp collapse in gold and silver prices at the end of January 2026 shocked investors who viewed precious metals as crisis hedges. The trigger was not a collapse in faith, but a surge in liquidity demand. Highly leveraged positions were unwound as margin calls cascaded across asset classes. What fell fastest was what could be sold fastest. This episode revealed something essential about modern crises. Safe havens are conditional. In environments dominated by leverage and automated execution, liquidity becomes the primary attribute investors seek. Assets that once buffered portfolios can become transmission mechanisms for stress. When correlations spike, diversification fails mechanically, not philosophically. Artificial intelligence intensifies this dynamic. Algorithmic trading systems respond to volatility thresholds without narrative context. When price levels break, selling accelerates regardless of fundamental valuation. Humans may hesitate, machines do not. The speed of adjustment compresses policy response windows from days to hours, sometimes minutes. Central banks are built for deliberation, not microsecond feedback loops. Beyond markets, technological concentration introduces operational fragility. A handful of cloud providers now underpin payment systems, trading venues, data feeds, and AI computation itself. This efficiency brings scale benefits, but it also creates systemic single points of failure. A cyber attack, software flaw, or geopolitical disruption affecting one provider could cascade instantly across financial infrastructure. Even more unsettling is the slow approach of quantum computing risk. Financial encryption standards assume that cryptographic systems remain computationally secure. That assumption may not hold indefinitely. If a breakthrough occurs faster than anticipated, the integrity of settlement systems, custody records, and digital identities could be compromised simultaneously. The probability may be low, but the impact would be absolute. When analysts speak of black swans, they often imagine unforeseeable shocks. In reality, most system-breaking events are foreseeable, but politically inconvenient or economically uncomfortable to address. The vulnerabilities of 2026 are visible. High debt, concentrated infrastructure, opaque credit, and geopolitical fragmentation are not hidden variables. They persist because correcting them requires short-term sacrifice for long-term stability. This leads to the concept that best describes a prudent stance in 2026, strategic sobriety. It does not mean pessimism or paralysis. It means rejecting narratives that promise frictionless growth, permanent liquidity, or technological salvation without cost. It means stress testing assumptions, not just portfolios. It means acknowledging that resilience comes from redundancy, buffers, and institutional humility. For policymakers, this implies resisting the temptation to paper over structural problems with temporary liquidity. For investors, it means questioning yield sources and understanding where risk truly resides. For institutions, it means preparing for nonlinear outcomes rather than extrapolating linear trends. The financial system entering 2026 is not doomed, but it is delicately balanced. History shows that such balances can persist longer than skeptics expect, then fail faster than optimists imagine. The difference between resilience and rupture will be determined not by forecasts, but by preparedness. That is the real lesson embedded in the risks, now converging beneath the calm surface. At this stage, the question is no longer whether the global financial system carries systemic risk, but how that risk would express itself under stress. Systemic crises rarely unfold as single explosions. They propagate through sequences, feedback loops, and behavioral shifts that transform localized problems into global events. In 2026, the most dangerous mechanism is cascade failure, where one market's attempt to de-risk becomes another market's source of instability. Consider the interaction between sovereign debt and financial institutions. Governments are issuing record volumes of bonds to fund defense, demographics, and energy transitions. Banks, insurers, pensions, and asset managers absorb this supply not because yields are attractive, but because regulations, collateral needs, and benchmark structures leave them little choice. Sovereign bonds are treated as risk, free for capital purposes, even when market risk is clearly present. This creates a paradox. The more the system relies on sovereign debt as its foundation, the more sensitive it becomes to sovereign stress. Rising yields weaken government finances, which in turn pressure institutions holding government bonds, forcing balance sheet adjustments that push yields higher still. This is not hypothetical. It has occurred repeatedly in emerging markets, and in milder form in Europe during the sovereign debt crisis. The difference in 2026 is scale and centrality. The United States has historically been exempt from this dynamic because of dollar dominance, but dominance is not immunity. It depends on confidence, liquidity, and relative attractiveness. As geopolitical fragmentation accelerates, reserve managers diversify incrementally, not abruptly. Each shift appears manageable. Over time, the cumulative effect reshapes demand curves in ways markets are slow to internalize. This slow, moving reallocation collides with faster, moving private capital. Hedge funds, proprietary trading firms, and systematic strategies respond to price action, not geopolitics. When yields rise through key technical levels, leveraged positions unwind mechanically. The result is volatility disconnected from economic fundamentals, feeding back into funding markets and risk models. Funding markets are where crises become systemic. Repo, commercial paper, and derivatives margining are the arteries of modern finance. They operate smoothly when trust is abundant and collateral values are stable. They seize when uncertainty rises. In 2026, these markets face structural headwinds, reduced central bank balance sheets, heavier collateral demands, and greater reliance on a narrower set of high-quality assets. This scarcity of pristine collateral increases competition for U.S. Treasuries even as concerns about U.S. debt sustainability grow. The system wants treasuries, but worries about them simultaneously. This tension expresses itself through volatility, basis trades, and episodic liquidity gaps. It is manageable until it is not. Households are another transmission channel often underestimated in macroanalysis. Elevated asset prices have supported consumption despite inflation. If markets correct sharply, wealth effects reverse. Credit card balances are already elevated, savings rates are low, and real wages remain under pressure for large segments of the population. A market-driven consumption slowdown would hit corporate revenues, worsen credit quality, and deepen downturn dynamics. Politically, this environment is combustible. Governments facing fiscal stress and social pressure are tempted toward short-term fixes, capital controls, financial repression, targeted bailouts, or regulatory forbearance. Each may stabilize conditions temporarily, but at the cost of longer-term credibility. Markets price credibility brutally when it erodes. International coordination, which proved vital in 2008, is harder in 2026. Strategic rivalry, sanctions regimes, and fragmented payment systems reduce trust. Central banks may still cooperate in crisis, but the political constraints around such cooperation are tighter. Swap lines, liquidity facilities, and coordinated interventions are no longer purely technocratic tools. They are geopolitical signals. This matters because financial crises are confidence phenomena. Once actors believe support will be delayed, partial, or politically contested, they act preemptively. Liquidity hoarding becomes rational. Risk aversion spikes. What begins as caution becomes self-fulfilling stress. The role of technology cannot be separated from this psychology. Information spreads faster, narratives crystallize quicker, and market reactions accelerate. Social media, real-time data, and AI-generated analysis compress perception cycles. Investors do not wait for quarterly reports or policy statements. They respond to signals, rumors, and model outputs in near real time. This speed favors those with liquidity and penalizes those with complexity. Institutions with layered structures, long duration assets, or opaque exposures are forced into defensive postures. This is why opacity itself becomes risk. When investors cannot quickly assess exposures, they assume the worst and withdraw. In this context, black swan events are less about surprise and more about threshold crossing. Systems absorb stress until a boundary is breached, then behavior changes abruptly, liquidity becomes scarce, correlations spike. Policy tools lose effectiveness, the system shifts regime. Looking ahead from early 2026, several plausible triggers could initiate such a shift: a disorderly treasury auction, a private credit fund gating redemptions, a major pension fund margin spiral, an AI infrastructure default, a cyber incident at a core market utility, or a geopolitical shock that forces rapid asset reallocation. None require imagination. All are plausible extensions of existing conditions. The challenge for policymakers and institutions is that preparing for such scenarios is politically and economically uncomfortable. It requires building buffers during periods of apparent calm, accepting lower returns, and tolerating criticism for caution. It requires acknowledging uncertainty rather than projecting confidence. Yet history is clear on one point. Systems that survive stress are not those optimized for efficiency, but those designed for resilience. Redundancy, transparency, and adaptability matter more than marginal yield or growth optimization. In finance, as in engineering, systems fail where they are most optimized and least buffered. As 2026 unfolds, the global financial system stands at an inflection point. It may continue to glide forward, supported by inertia and optimism. Or it may encounter a shock that reveals how tightly coupled and thinly buffered it has become. The outcome will depend less on forecasts and more on whether key actors recognize the nature of the risk before the system forces recognition upon them. If there is one lesson that emerges from every major financial crisis, it is that the trigger is rarely the true cause. The cause is accumulation. Leverage accumulates, assumptions accumulate, fragile dependencies accumulate. By the time the system breaks, the event that receives blame is merely the spark, not the fuel. In 2026, the fuel is already present across multiple layers of the global economy. The defining characteristic of the current environment is constraint. Monetary policy is constrained by inflation. Fiscal policy is constrained by debt. Political systems are constrained by polarization and legitimacy deficits. Technology is constrained by concentration and energy intensity. When constraints tighten simultaneously, flexibility disappears. Systems that rely on constant adjustment lose the ability to adapt. This is why the concept of systemic risk must be understood not as a probability, but as a topology. The question is not whether something will go wrong, but how many pathways exist for stress to travel once it does. In 2026, those pathways are numerous, short, and highly interconnected. Financial institutions, governments, households, and technological platforms are no longer loosely coupled. They move together. From an individual investor's perspective, this environment challenges traditional portfolio logic. Asset allocation models built on historical correlations assume that diversification reduces risk. In highly leveraged, liquidity-driven systems, diversification often delays risk rather than eliminating it. When funding conditions tighten, correlations converge. Losses appear simultaneously across assets that previously behaved independently. This does not mean risk cannot be managed. It means risk management must shift focus from return optimization to survival under stress. Liquidity matters more than yield. Balance sheet strength matters more than narrative. Complexity is a liability when transparency disappears. These principles are not new, but they are frequently ignored during periods of calm. For institutions, especially pensions and insurers, the challenge is acute. Long-term liabilities encourage reach for yield, while short-term liquidity requirements punish illiquidity. This mismatch cannot be resolved by clever engineering alone. It requires governance discipline, realistic return assumptions, and acceptance that some promises made in low-rate eras may no longer be costless to honor. For governments, the choices are starker. Debt trajectories are not infinitely flexible. Demographics, defense, and climate commitments create spending pressures that do not recede in downturns. If growth disappoints, trade-offs become unavoidable. Inflation becomes tempting as a silent redistributor. Financial repression becomes attractive as a way to trap domestic savings. Both erode trust over time. Trust is the invisible asset underpinning financial systems. It allows institutions to fund long-term assets with short-term liabilities. It allows currencies to function beyond their borders. It allows policy promises to anchor expectations. When trust weakens, systems demand collateral instead. When collateral becomes scarce, systems freeze. In 2026, trust is strained but not broken. That distinction matters. It means outcomes are still contingent. Policy choices, institutional behavior, and investor discipline can influence the trajectory. Crises are not fate, they are outcomes of interaction between structure and response. This is where strategic sobriety becomes more than a slogan. It is a framework for decision making under uncertainty. It rejects both denial and panic. It acknowledges risk without assuming inevitability. It prioritizes resilience over short-term performance and optionality over precision. Strategic sobriety asks uncomfortable questions. What assumptions underpin current valuations? Where does liquidity truly come from under stress? Which exposures are contingent rather than visible? What happens if multiple safeguards fail at once? These questions do not produce clean answers, but they reveal blind spots. They also reframe how black swan events should be understood. Black swans are not rare because they are unimaginable. They are rare because systems are designed to suppress volatility until they cannot. When suppression fails, outcomes appear discontinuous. In reality, the underlying processes were continuous all along. The financial system of 2026 is suppressing volatility through leverage, narrative confidence, and policy credibility. Each works until it doesn't. The moment confidence shifts, suppression mechanisms reverse into amplifiers, liquidity drains, prices gap, policy tools lag. This is the nonlinear nature of systemic crises. None of this implies that collapse is imminent or unavoidable. It implies that margin for error is thin. Small mistakes have large consequences. Complacency is expensive. Overconfidence is dangerous. History offers perspective. Every generation believes its innovations have eliminated old risks. Every generation eventually learns that risk only changes form. The instruments differ, the institutions evolve, the incentives remain human. As 2026 progresses, the world will likely experience periods of calm, punctuated by sudden stress. Markets may rally even as vulnerabilities deepen. This is how late-stage systems behave. They appear strongest just before their constraints bind. The responsibility of policymakers, investors, and institutions is not to predict the exact timing or form of the next shock. It is to recognize that the system is operating closer to its limits than headlines suggest. Preparation, not prediction, is the rational response. Ultimately, systemic risk is about humility. It is about accepting that complex systems cannot be perfectly controlled, only managed. It is about designing structures that can absorb failure without collapsing. It is about choosing durability over elegance. In that sense, the most important asset in 2026 is not capital, technology, or growth potential. It is judgment. Judgment to resist excess. Judgment to build buffers. Judgment to act early when action is unpopular but effective. Whether the coming years are remembered as a period of adjustment or of rupture will depend on how that judgment is exercised. The black swans of finance do not announce themselves. They emerge when accumulated fragilities meet constrained responses. The signs are already visible. What remains uncertain is whether they will be heeded in time.